So as I mentioned in the last video, corporations can have multiple kinds of stock. One of the stocks that they can have outside of common stock is called preferred stock. Preferred stock has additional rights over common stock, so they have preference to dividends. They generally have cumulative dividend rights, which means that in years where the company decides not to sell dividends, they still have a liability to give dividends to preferred stockholders. So in years when they do issue dividends, preferred stockholders get to collect on all of the years that they didn't get dividends before anything gets issued to common stockholders. They get preference in the event of a liquidation or bankruptcy. They have a call feature that allows the corporation to repurchase that stock. However, preferred stock owners do not get the voting power that common stock owners do. This example of a balance sheet shows a corporation that has both preferred and common stock. So we see some information here about the common stock, where it says it has 9% cumulative preferred stock at a $100 par value. What that 9% cumulative refers to is the dividend rights of that preferred stock. So that means that that preferred stock has a 9% dividend that the company is on the liability to pay every year. If the company chooses not to pay it 1 year because they're holding cash for another event, then they have to record that liability in their books, and when they do decide to pay dividends in the future, they have to pay back every year that they've skipped to the preferred stockholders. So that's what the cumulative means. The stockholders get 9% of their $100 par value stock as their dividend amount. So we have this example here where we have 100,000 shares of common stock with a par value of $25 that were sold for $28 per share. We also have 1,000 shares of $100 par value preferred stock that was sold for $110, and a balance in retained earnings of $80,000. So if we're wanting to prepare the stockholders' equity section of the balance sheet, we're going to start with our preferred stock. We have 1,000 shares at $100 par. Then we have our common stock, and there we have 100,000 shares at a $25 par. Then we have additional paid-in capital, our preferred stock, additional paid-in capital, and our common stock, additional paid-in capital. We have our retained earnings of $80,000, and that gives us a total stockholders' equity 900. Sorry about that. So, stock dividends. Dividends are cash payment to our shareholders. They are paid out of retained earnings. We have to have retained earnings in order to pay dividends. With our preferred shareholders, there's no guarantee that they'll get a dividend. However, they do receive dividend preference over common shareholders because they must be paid their contracted dividends before common shareholders can receive dividends. We can specify what their dividends are in terms of dollars or as a percentage. So if you saw on that previous slide, we had them stated as a percentage, so 9% of dividends. So he said the main reason that dividends aren't guaranteed is because companies have to have both cash available and retained earnings in order to make dividend payments. Cumulative preferred stock means that we have to pay them and we have to maintain a liability if we don't pay those dividends. When we have cumulative preferred stock and we decide not to pay a dividend in a year, then we have what's called dividend in arrears. That dividend in arrears becomes a liability for our company because we can't pay any dividend out without going back and paying anything we've accumulated in our dividends in arrears. They're not included in the liabilities section on our corporation's balance sheet, but we do have to disclose them in the financial statements footnotes because we do have to pay them at some time. So we have an example of a footnote from an annual report here on this slide where they have dividend in arrears at an amount of $140,000 that states that if they do pay dividends out, they first must cover this $140,000 dividend liability. Here we have a company that has 100,000 shares of $100 par value cumulative preferred stock. It has a dividend rate of 7%, and the company has not declared any cash dividends on the preferred stock for 3 years. So we want to calculate what the amount of dividends in arrears are for the last 3 years. So we have a stock, we have 100,000 shares. We take that times our $100 par value times 7%, which is their 7% dividend rate, and take that times 3 years because we've accumulated 3 years. So that gives us an amount of $2.1 million. So the amount of dividend in arrears gets disclosed on the financial statements. They're not formally included in a liability, but they are a potential liability because if our board of directors would ever declare a dividend, we would be required to pay this $2.1 million first. When we're just looking at regular stock dividends, we have a corporation here where we have common and 6% preferred stock. So our preferred stock has a $100 par value, it is cumulative, and our common stock has a $50 par value. So we're looking at if the company declares a total dividend of $225,000, if the dividends on preferred stock are 1 year in arrears, how will the total stock be divided between the common and preferred stock? Well, first we have to figure out what we owe for 2 years of preferred stock. So when we're looking at that, we do that same thing where we have our 10,000 shares of preferred stock times our $100 par value times the dividend percent of 6% times 2 years. We're 1 year in arrears, and then we have this current year. So that's a total of 2 years. So that tells us that we owe our preferred stockholders $120,000. If we have a total dividend declared of $225,000, we owe our preferred stockholders $120,000. That leaves $105,000 to be divided among our common stockholders. So we would divide that $105,000 by our 50,000 shares outstanding, and that's how much each common stockholder would get per share as part of their dividend.